Hello, everyone. We're going to move on to chapter 14. I know everyone always says, why do we move to chapter 14 now? It's because I feel like accounting is the foundation of most other business practices. Also, I have a degree in accountancy, a master's of accountancy, so I'm very familiar with that information, and I just feel like this is a good fit on it. I also want you to cover accounting before we get to finance. We have to cover finance next week so that you can start on your stock portfolio project. So it's a natural progression. If any of you just really enjoy accounting and you have information or you want information about being an accountant, please contact myself and I'll talk to you or else direct you because accounting is a great career. There's always openings in accounting, it pays well, you promote fast. So if you enjoy it and you understand it, it's a good career. Um, all accounting is the recording, measurement, and interpretation of financial statements. You get the information, you get the information, you record it, and then you prepare financial statements that share that information with other users. A certified public an accountant, a CPA, is a person who has completed 150 hours of college credit and they have sat for a state exam and they can sign and document that financial statements are correct. If you're a CPA, it is really the highest level of accountant that you could be, and you just quickly move through the ranks at CPA firms, accountant firms, and can become hugely successful. CPAs can sign off on financial records, tax returns, and audits of corporate financial records. An audit is where an independent CPA auditor comes into an organization and takes a look through all their financial statements, spot checks, and makes sure that they've been honest in their recording of this information. Private accountants are someone who works within a private business. So if you're a CFO, a chief financial officer, you're employed by a large corporation, you work for the government, and you're an internal accountant, you're considered a private accountant. And a certified managerial accountant is someone who specializes in managerial responsibilities within a private company. So a CMA is a private accountant. Many people get confused between what accounting or bookkeeping is. Accounting is where you make those decisions, where you figure out how it should be done and why it should be done. Bookkeeping, on the other hand, is just the daily business of inputting the information, and then you print out the financial statements and give them to the accountant, who then does the analysis of them. Accountants, before they can sit for their CPA exam, they have to complete 150 hours of coursework. It does not have to be in accounting, but the CPA exam is difficult, and it is better if your coursework is in accounting. So who uses accounting financial statements? Certainly managers and owners use their financial statements to plan, to control, to report to the Internal Revenue Service, to give to stockholders, to apply for credit, to sometimes they share those financial statements with their employees, especially if they profit share with their employees. And they always share it with the bank when they want a loan, because that is how a bank decides if they're going to give you money or not based on the profitability of your company. Within the organization, people who use it are your board of directors, owners, shareholders, management, in business control or business research, for internal control of costs. Almost always the business is managed, especially big business, is managed by somebody other than the owner. So they use those financial statements to keep track of how they're spending somebody else's money, how they're spending the owner's money. Outside stakeholders, external users, are the IRS, who collect taxes, regulatory agencies, especially if you're a company that is publicly traded on the stock market. Sometimes special interest groups, customers, employees, the media, banks. And you ask, why would a customer care about a business's financial statements? Well, the best example I can give you is if I'm going to purchase something that has a long-term warranty, like a car or a home, then I want to make sure that the business has a good financial statement, that they have good profitability, and good long-term assets, because I want to make sure they're going to be able to honor that warranty that they promised me when I bought their product. Um, Internal uses, not users, managerial accounting, to budget, to plan, to direct activities, to decide if you can hire people, to decide if you need to buy more product, to decide if you need to expand. Cash flow is how the money moves through your business. And budgeting, forecasting for the future, and just figuring out if you have enough money to make it through the next month, the next quarter, and the next year. External users, these audited financial statements that certified public accountants sign off on, are used for your income tax. The federal government requires that businesses pay income tax. If you want to get credits or you need to get a loan, you have to have these audited financial statements for the creditor, and reporting your results to the stockholders. Stockholders, a little different than stakeholders. Stakeholders are anyone who has an interest in your business. Stockholders are people who own a portion of the business, own stock in the business. So if you own stock in Walmart, you may just own 5 shares of stock out of millions, but you still are an owner of that company. So the accounting equation. If you don't learn anything else in this class, I want you to learn the accounting equation. And I'm going to go through that with you quickly. Assets equals liabilities plus owner's equity. This is the accounting equation. Well, let me explain this in terms that you might understand. Asset, let's say you purchase a car. It is an asset. It is something you own. In a business, your assets may be a building, office equipment, office supplies, vehicles, inventory, anything that's tangible that the company owns. Equals liability, which is the dollars you owe, plus owner's equity is the dollars that the owner has invested or retained earnings, which is money that the company has paid and has not paid out to the stockholders in dividends. Okay, so let's put some numbers here. Let's say you purchase a car that's worth $20,000 and you make a $5,000 down payment. So your liabilities are going to be $15,000. So your asset is your car, your liability is your loan for $15,000, and your retained earnings are what? Your portion of what you own in the car. So to restate this, your asset is what you owned, and your liability plus owner's equity is how you paid for it. You may have paid for it with some of your own money plus a loan from the bank, a liability. So the accounting equation is one thing I want to make sure that you take away from this class and that you understand, and that when you go to your next class in business, which is going to be an accounting class, that you already know what the accounting equation is. Assets equals liabilities plus owner's equity. Study it, remember it. I promise you there'll be questions in the quiz about it. When you get to accounting class, it will be the first thing you learn is the accounting equation. And it may be one of the few things you remember from your Business Foundations class. Double entry bookkeeping just says that we have to have debits and credits, debits on the left, credits on the right, and we make at least two entries for each transaction, and it keeps our accounting equation in balance. So the 4-step process, it's actually a 9-step process that you'll learn in accounting, but all we need to learn here is the 4 steps. You examine the source documents. Source documents may be a receipt, a time card, a expense, a credit card bill, any kind of document that comes to you. You record those transactions. You post those transactions to a general journal, and from those general journals you prepare financial statements. Like I said, when you get to accounting, you'll learn that there's a couple of little steps in there, but for this purpose, it's a 4-step procedure for an accounting system to keep track of the transactions for a business. A journal is a chronological or time-ordered list of transactions. A ledger is where you keep track of each separate account, and a trial balance is a summary of the balances of the accounts in the general ledger. An income statement is revenue minus expenses. Revenue minus expenses equals net profit. That's all that's on the income statement. When the expenses are greater than the revenue, you have a net loss. We hope all businesses always have a net profit, but they don't. Sometimes they come up with a net loss. So when your expenses exceed your revenue, you have a net loss. Don't you just love the way this board sounds when we erase it? And I've dropped my marker. That's okay, find another one. So that's your income statement. These are terms that can be interchangeable, like revenue or sales. Gross profit is the same as gross income and gross earnings. So this is just a list of some general terms that are interchangeable when you're looking at accounting information. Okay, gross income, I just told you. Revenues minus the cost of goods sold. Cost of goods sold is when you have a manufacturing or a retail organization. The income after paying all those expenses is your gross profit. After that, you get your gross profit. You subtract your general, selling, and administrative expenses, research and development, interest expense, and then you get your net profit. Depreciation is a word you're going to hear a lot throughout your college career. Depreciation is where it's like peanut butter. You spread the cost of the expenses out over several years, just like you would smush peanut butter out on a piece of bread. So let's say you buy, this says a piece of manufacturing equipment for $100,000, and you expect it to last for 10 years. Well, you have to match the expenses to the time periods in which they produce revenue for you. So instead of saying in this first year we're going to write off the whole $100,000, if we're going to use it for 10 years, we have to spread that $100,000 out over 10 years. So you would account for the cost of that or the expense of that piece of machinery, $10,000 a year for 10 years as opposed to $100,000 in 1 year. And spreading out of those costs over the useful life of the equipment is called depreciation. All right, told you what net income is. Total profit or loss after all expenses, including taxes, have been deducted from revenue. It's also called net earnings. The balance sheet is our next financial statement. There are 3 financial statements you'll learn about in your business career. One is your income statement. I already talked to you about that. All it has are revenues and expenses, and you find your net profit. The next one is your balance sheet. The balance sheet is a snapshot of your organization's assets, liabilities, and owner's equity at one point. So the balance sheet, in essence, is a reporting of the accounting equation. Assets equals liability plus owner's equity. And the third financial statement is called the statement of cash flows. Statement of cash flows just show where money has come from and where money has gone. It's a cash doesn't lie. So when a company is really trying to figure out where their cash came from and went, they can look at a statement of cash flows and then they figure out exactly where all of their money went. There are 3 areas, I call them buckets, that cash can come from or go to: inflows of cash and outflows of cash. The first bucket is from operating activities, and that's just the general business your company does. The second is investing activities. It's the changes in the long-term or fixed assets. And financing activities is the third bucket, and that's where you've either borrowed or paid back money. Dividends per share is the actual cash paid to each owner for how much they own in the company. So if you buy a share that costs $20 and you own that much of the company, but at the end of the year the company pays a dividend of 30 cents, then you get 30 cents for each share that you own. As I've just told you earlier, that the importance of integrity is so important, especially for business owners and accountants. People rely on financial statements, especially audited financial statements that have been signed by a CPA. Transparency and accuracy is so important. So if you're looking at accounting, thinking about accounting, remember the importance of integrity in accounting. And the last thing I want to talk to you about is compliance to accounting principles. It's just so important that everybody be able to trust the financial statements. I'm going to post this PowerPoint separately. I'll post it with the video, and then I'll post it separately. I know this is a quick review of accounting, but we only get 1 week for each subject matter. So that's all for today. Next week I'll be reporting to you on finance, our money system, and the stock market. And I hope you all have a really good week. Thank you.